Today, we will talk about how to consolidate your retirement accounts. Let's have a look at the details. With workers changing jobs every few years, many people have multiple retirement accounts. You might want to combine these accounts so they are easier to manage. Alternately, you might think that one is better than the others, so you want to transfer all of your retirement funds into it. Combining accounts is easy. Most of the legwork will go into deciding which accounts you can combine. If you need help, meet with a financial planner. The first method is choosing which accounts to consolidate. Get paperwork for all retirement accounts. Find your plan description. You will also want recent statements so that you know the balance in each account. Make sure the paperwork is recent, preferably within the past 60 days. Identify the account that will receive the transfers. Before you consolidate your accounts, you'll need to understand the differences between the accounts. You'll have some advantages with a 401k you wouldn't have with an IRA, and vice versa. Consider the following when identifying which account will receive the transfers. Performance over time. Investment options. Fees. Tax advantages. Check whether you can transfer funds. You might not be able to consolidate some retirement accounts. Or you may be able to transfer the funds but lose certain tax advantages. Consider the following. IRA. You can transfer a traditional IRA into another traditional IRA or even a Roth IRA after paying taxes. 401k. You can transfer the 401k into an IRA. Tax-sheltered annuity. These plans, typically called 403b plans, can be rolled over into a traditional IRA, Roth IRA, and qualified plans, such as a 401k. Employer stock. You can roll stock into an IRA, but you'll lose tax advantages. Assess if you will need the money early. Some people borrow from their retirement accounts for a variety of reasons. You'll want to assess if you'll need the money because this will determine which account you should merge the others with. Talk to a professional. Only an experienced financial planner can provide tailored advice on how to combine your retirement accounts. You can find a financial planner by looking in your phone book or searching online. Also ask people you know for referrals. Now the second method is rolling assets into a traditional IRA. Decide if you should consolidate in a traditional IRA. A traditional IRA has many advantages. For example, they often have more investment options than employer-sponsored plans, such as a 401k. Choose an IRA to receive the funds. You might already have an IRA you want to roll other accounts into. However, you can also shop around and find an IRA that suits your needs. Search online or contact an investment professional and talk about which traditional IRA will suit your needs best. Set up an account. You can set up an account with a large provider, usually online or over the phone. You'll need to provide the following personal information: name, social security number, contact information, date of birth, employment information. Choose a transfer method. Now you need to get money out of account A into account B, which is your traditional IRA. There are generally two ways you can transfer funds. Indirect rollover, which will send you a check in your own name. You then have 60 days to transfer the money into the new account. If you wait too long, you must pay taxes on the amount and may also pay a 10% early withdrawal penalty. Direct transfer. With a trustee-to-trustee transfer, you don't ever touch the money, so you don't have to worry about depositing the money before a deadline. Complete paperwork to authorize the transfer. Call up the plan administrator for the plans you want to roll over into the IRA. Give them the information about the IRA you want to roll over your account into and instruct them to make a direct transfer. And the third method is consolidating in a Roth IRA. A Roth IRA is a great choice for consolidating retirement accounts. If you think your income will be higher in retirement than it is presently, contributing to a Roth IRA is preferable to contributing to a traditional IRA. Find a Roth IRA provider. Many companies provide Roth IRAs. You can research them online or talk to an investment professional. Open your Roth IRA. You can typically open a Roth IRA on the provider's website. You will need to provide your personal information like name, social security number, date of birth, contact information, and employment information. Complete the forms to authorize the rollover. Contact the plan administrator for an account you want to roll over into your new Roth IRA. Remember to hold on to copies of all forms before you submit them. Transfer the money. You might get a check directly from your traditional IRA or employer-sponsored plan. You will need to deposit the check into your Roth IRA account. Don't delay. You must roll over the money within 60 days or else pay taxes and a potential 10% early withdrawal penalty. Pay required taxes. You'll probably have to pay some taxes on the money you transferred. For example, if you had money in a tax-deferred account, such as a 401k or traditional IRA, then you contributed money to those accounts on a pre-tax basis. Now you will need to report the amounts and pay taxes. You'll receive Form 1099-R, which will show how much you need to report to the IRS. Use a worksheet to determine how much tax you must pay. Thanks for watching this video. Please don't forget to like and subscribe to our channel if you like our videos.